Q1 GDP misses estimates, and Amazon drops 15% on earnings. Defensive sectors start to sell off as correlations rise, and the dollar breakout picks up momentum as we approach FOMC this week. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Today is May the 3rd, and let's take a look at these markets, what's been going on. So last week, obviously was a big week in terms of earnings, but we also had some key macro data points that were a bit disappointing. So you had your US Q1 GDP coming in light, and then you've also had ISM manufacturing coming in shy of expectations. And then on a global level, you've also had China PMIs reflecting some of these lockdowns and they're starting to, roll over a little bit there as well. So, a good way of sort of encompassing that is this economic surprise index that CITI put out. And that's been rolling over quite steeply since the middle of April, right? So you can see in the top left chart, this is the CITI Economic Surprise Index, tends to be a little bit of a leading indicator. And that's quite a dramatic move, right? If you can see, it obviously had a nice little run up earlier in the year, but it's now starting to roll over a bit. So arguably could be a bit of a lead indicator on actual growth when you start to see these sort of things roll over, and these surprises getting worse and worse could potentially be the start of something. And we've been saying, we've seen a lot of leading indicators for the economy starting to smell a bit bad. So starting to kind of see that reflected in these type of numbers that we're seeing in economic data. If we then look at sort of market action, well, equities were pretty mixed. So you had US obviously lower, with higher rates kind of being a bit of a driver there, and some of those tech earnings disappointing a little bit, particularly Amazon. But we'll talk a bit more about earnings in a minute. EU was relatively flat, so European markets not having dramatic moves last week, but then China was actually up a decent amount, right? So China index there, putting in about a 5% rally. And that was kind of on the back of stimulus hopes, as Xi's talking about infrastructure bills and things like that to support the economy. And people are thinking that there might be some truth there. Up until now, it's been all talk and no action from China. But because, by sort of June, July, he needs to be kind of not re-elected or nominated for this lifetime in control. And people are saying, well, the only way he's going to nail that on after the impact of these lockdowns is if he does do something on the stimulus side, right? So people are starting to anticipate that, and the market's staging a bit of a bounce in China. Then if we look at commodities, still correcting lower, led by metals. So really copper, gold, silver all getting trashed a bit there. Obviously linked to China as well, a little bit Chinese demand, things like that. Affecting that, and also people being quite long, and we'll talk a bit more about what's happened in terms of liquidation and stuff within commodity sector, but really energy bucking the trend there, that managing to rally with natural gas and oil, and you've got that kind of whole Russian embargo, sort of the EU talking about a complete ban on Russian oil and gas. Germany have actually backed it, whereas Hungary obviously vetoing it because they're closer to Putin. So they're kind of back and forth on that, but talking about by the end of the year, putting that through potentially, which is obviously keeping a bit of a bid in terms of oil. And then lastly, DXY obviously continued to charge higher to multi-year highs. And US yields are also up about 10 to 15 basis points across the curve, with a little bit of curve steepening as well. So those are the sort of main things we're seeing across asset in terms of movement. If we look a little bit at the earnings, it was those mega cap tech stocks really that were the big focus last week. And we saw Facebook actually up. So first time in a while, right? Those earnings last 3 times have been a shocker. Finally, Meta coming in with a 15% rally on earnings, with better than expected numbers. But then it was the other guys that actually sort of let the side down, basically. You see Facebook, obviously the standout winner there, finishing about up 8 and a bit percent. Then you had Microsoft pretty flat. That actually sort of outperformed in terms of on its release. Apple and Google were a bit softer. And Apple kind of citing, concerns around Chinese demand and things like that. And then finally, Amazon taking a big hit around 15%. So Amazon, obviously, the big concern there was the e-commerce business. Their cloud business still continues to make a lot of money, but the e-commerce business was a problem, and that's kind of bleeding money, right? So, and the guidance isn't looking that great. Overall, if we then look at the next chart, which is kind of talking about negative and positive earnings surprises and the impact it's having on the shares. Remember, like a couple of weeks ago before earnings season, I was saying we need to watch how these things trade post misses, or if they do miss, and are they getting punished for it? So you're basically seeing here, if you go back to Q1 earnings seasons all the way back to 2005, and you compare, what on average is happening to stocks when they beat earnings and when they miss, then there's quite a big skew to the downside, right? So you can see here about, looking like I don't know if that's a Z score or a percentage there, but basically quite a big skew. Whereas in previous quarters, you've had it a bit more neutral. Here, the uptick you're getting on a positive number relative to the downtick you're getting on negative. It's quite dramatic, right? So it really does give you a sense of, what people are looking to here. And it's the guidance, and the guidance, not great guidance is getting punished. So, as things are kind of turning south, and, Morgan Stanley was expecting earnings growth to go negative by the end of the year and stuff like that, right? So kind of starting to really play out the stuff that we've been talking about. Okay, and then the last thing I'd say about earnings is that, you've had earnings are holding up, as obviously the ones that are missing are getting punished, but overall earnings are holding up. And that's because a lot of companies were able to pass on the impact of higher prices to consumers, right? And that's because the real big price spike didn't happen until later in Q1, right? Like March. Now, as prices have continued to escalate and be passed through, I think we'll see probably the real impact of that and what that's done to kind of consumer demand and the profit margins and things like that. And where the demand has really suffered, we'll see that in Q2 more, basically, right? So the sector breakdown, let's say, of the last month of performance, right, and how that's evolved through time. I found this to be quite a informative chart. So top left, so you can see here, as the month started out, and the white line is the S&P, right? So the white line is the S&P performance, and sort of to the middle of April, the S&P performance kind of hanging in there around 0%, right, around flat. But the colored bars basically tell you what the composition of that flat performance is, right? So you can see the defensives, right? The likes of consumer staples, utilities, healthcare, things like that. They were holding up the market. Also, the commodity sectors like energy and materials were holding up the market. And the things that were down were, like your financials and your tech and your consumer discretionary, things like that. It was in the second half of the month that you then started to see those more cyclical things accelerate lower, but even the defensives kind of got dragged back down as well, right? So you had, in the first half of the month, you had more of a rotation, and in the second half of the month, you just kind of, everything had to go, basically, right? So even the places where people were hiding and were parked, even those were getting sold, okay? So that kind of dispersion that you saw earlier in the month went away, and you started to see a higher correlation between all of the sectors and them all going down, basically, right? And you kind of need to see that more correlation one type move to kind of put in an actual bottom and like see a real capitulation of the market, right? I think we're only seeing the beginning of it, but the fact that we are starting to see the beginning of it is basically telling us, yes, that's the type of price action that you get either, during or, towards the end of that final leg down, okay? The top right chart is the implied correlation, right? And that's gone up to 51. So what that means is that the options market is pricing correlation higher as well, because it's seeing that it's basically paying up for index vol relative to single stock vol, which is basically saying, we're not looking for dispersion of sectors and some to go up and some to go down anymore. We kind of think they're all going to move together. And so the index is just going to, whatever the index does, everything's kind of going to do to an extent, basically, right? And that's when you see implied correlation go up. And when you get a real proper correlation one crash, that's when that implied correlation, if you look back at March 2020, that can go to like 70 or something, basically. Right now, it's kind of gone from the mid 30s back up to 50, which is a significant bounce, and the market's pricing in that high correlation going forward. But like I say, that's another thing that when that goes to 60 or 70 and the market's on its knees in the mid 3500s, then we'll get a good sense that yes, that all the things that we need to see to say the bottom is potentially in, like on the more medium term, that's what we'll be looking for basically, right? So it's worth kind of knowing where that is. And we're also seeing outflows from global fixed incomes. It's not just equity outflows we're seeing fixed income because risk parity is doing so badly. So as the correlation between equity and fixed income goes up, the volatility of risk parity books goes up. So then they need to degross their books, and that just degrossing their books is effectively selling equities and selling bonds. So then you see this liquidation type move that we've been seeing, like, and the bonds have been getting killed. So that's one of the reasons. And then you look at the money market flows, they've spiked up. So you're seeing people putting money into money markets to reduce duration risk, right? So they got to park their money somewhere, and money markets is kind of like your more cash equivalent type stuff. That's where the money's kind of been going. Yeah, so we are starting to see that move out of the, the whole sort of asset spectrum into the most defensive part, basically. And that is you need to see that to feel like we're anywhere close to a bottom. Then you've got sentiment indicators, obviously flashing pretty oversold. This GS thing is signaling a buy signal where they're looking at the Z score on various positioning indicators. So now that short-term buy, I bear in mind that's a short-term buy signal, right? Because they're looking at more discretion. The real money still has plenty of room to de-risk, right? We started to see some outflows from the real money. There's, Hartnett from Bank of America put out a nice piece talking about that over $1 trillion worth of inflows into equities. Like, what was the average level that got into the market? And that was coming in at around 42.50 kind of area. And he's suggesting that if we were to break below 4,000, then some of that money is going to capitulate and come back out of the market. And we already started to see those flows start to roll over, basically. So you may get an acceleration from the real money crowd. The fast money crowd, the hedge funds, etc., already out and probably a bit short. But the real money crowd needs to potentially, de-risk some more. That's kind of what he's suggesting. Okay. Now, if we home in on S&P price action and kind of what's been happening there, we had quite a volatile range, right? Last week, we managed to rally up towards 4,300, rejected it, then managed to recover back to there again, and it got smacked down again. So we're talking about, in general, if we say the range was around 4,120 to 4,300, it's about a 4% range that it was trading in, and it was moving from the top to the bottom of that quite violently. And then we had that breakdown sort of yesterday, really, that acceleration lower. Now, that was partly driven by this European price action where we had May Day bank holiday, so liquidity was kind of reduced. And then apparently one of my, from my old shop, Citibank, one of the index traders there did some miscalculation on the amount of futures that they need to sell on the Swedish market. And they basically pummeled that market down. So there's a bit of a flash crash. Because of an error, and then that got unwound and the market basically recovered from it, right? So that was kind of what drove some of that crazy price action rather than anything too dramatic over the weekend. I mean, you did see Chinese PMI numbers rolling over a bit, but that move was a little bit of a panic sort of move because of a mistake is what I'm hearing. Yeah. Now, if we look at the kind of levels, like I said, 4,300 was that resistance zone. It kind of really struggled to break above that. The tech earnings disappointment and the weaker macro data was the reason why you had these little cascades lower. And in quite a short space of time, the market found itself down 100, 150 points. Spot gamma's level at 40.50 turned out to be pretty spot on, right? Within a whisker of that before the market found some support. And then you had that late day rally where it really kind of went back to 41.50 in short order. In terms of, post FOMC, we could see a bit of a rally because the VIX if the VIX can manage to move a bit lower. Obviously the VIX is fairly elevated right now. So a move from 30 odd back to 25 is still, it's still an elevated level of VIX, but it might give us some fuel for a bit of a rally post FOMC, right? So that's what we should be kind of on the watch for. Very typical price action that we get from FOMC if it doesn't create some massive event or massive market move. And like I say, for them to be incrementally hawkish and surprise on the hawkish side that would surprise me, to be honest, right? It's quite a high bar, quite a high hurdle rate, I think, to get over that. If we look at sort of the volatility positioning in more detail, Still obviously short gamma territory, as we have been for a while. Seeing a few signs again, you know, apart from just the fact that FOMC is probably going to bring a bit of a reset in vol to some extent, we're seeing this volatility divergence again, right? Where you see markets go to lower levels, but VIX doesn't manage to put in a high, right? So saw that yesterday where we broke down, we went below those March lows intraday. So we didn't manage to stay down there, but intraday, you know, we got the reversal back, having touched those lower levels. But when we were down there, the VIX was not above like 38 or wherever where it got to back in March, right? So when you see those lower levels in spot and you're not getting the same sort of aggressive buying of vol and those high VIX levels, that volatility divergence can often signal a bit of exhaustion of the sell-off and could be a bit of a buy signal, basically, right? So that's one thing to be aware of. In terms of the flows, we did see put selling. You can see from the hero indicator, put selling pretty much out the gates. Market didn't really do much to it initially, and then you got that large spike up there, which is like quite an acceleration in the put selling, and then the market did go up with that basically into the close. And you know, it kind of makes sense, right? If you have owned puts, we're getting towards that put wall where there's quite a lot of open interest around the 4,000 strike. If you happen to be lucky enough to own those strikes, you're probably going to want to bank some of them, right? So not a massive surprise to see some put selling coming in. But, you know, whether it's naked shorts being put on or profit taking, we don't know. But I suspect it's a reasonable amount of profit taking, as you often get when you're approaching that put wall, which is why it acts as support in the first place, basically. And when you've got an inverted VIX curve, like this curve down here, even more reason to be getting rid of some of those short dated options and maybe looking to longer dated puts or put spreads or something like that to reduce some of your delta and gamma that you've made money off. Keep your protection on, but just kind of roll it down the curve. That's what a lot of the smarter sort of institutions with hedges on will be doing in that environment. Yeah, you see here, getting to around 104. This is big long-term resistance zone that I'd kind of flagged, right, going back to 2017, where we kind of topped out a couple of times. But if you look at that massive green candle, I mean, that's really taking the momentum indicator through its recent highs, right? So hard to really call a top in dollar here, even despite it being quite overbought. So you may well get a reaction to this level, but that seems to be in quite a strong uptrend right now, right? And it makes sense. There's fundamentals backing that move up as well, right? It's not just a technical break. And then it's quite broad based, right? So it's not just obviously Euro and Japan driving it to some extent, but then you've also got, you know, before you were having some of these emerging market commodity currencies doing quite well against the dollar, despite the DXY trading up because of the heavier weighting of euro and yen and things like that. This time around, the dollar's up against everything, right? So you're seeing, you know, Norwegian krona, Brazil, Aussie, everything weakening against the dollar. So a pretty broad-based move. You know, if we then look a little bit at FX vols, you know, I obviously flagged the trades that I've had on there in dollar, yen, and euro puts. Dollar yen calls 6 month and euro put 6 months. So, you know, you can see here, you've got the levels of vol moving up over the last month. So even though the realized, you can see that the orange dot is the realized vol. So even though the realized vol is kind of in line with where the implied was a month ago, which is the red curves, you can see all the curves have shifted up, right? So euro 6 month vol's up a decent amount, yen's up even more. And it's because of these obviously parabolic moves, right? You've got the yen move taking us up to 130 in such a short space of time. But, you know, whenever it was 2 or 3 weeks ago, when that vol had moved up only marginally, it just made sense to own some of that, right? Because it had so much potential for such big moves. I mean, for all we know, this thing's headed to 150 over the coming months, right? Which is absurd if the possibility that it could get there. But even now, I mean, the vol has gone from 8 to 11, so it's a decent uptick. But you know, it's one of those things. I think now I'm starting to think it's kind of done quite a bit, so I wouldn't be buying it here. That's why I've taken about a third of my position off and just sort of used that to kind of pay for it, basically, right? So I'm still in the trade because I still want that hedge, right? In the world that we're currently in, you're crying out for hedges that are going to work, basically, right? And you look at equities trading down, but it's trading down in a choppy way. yes, the vol will spike, but then it will get sold back down quickly. And if you don't monetize it, you might miss it and things like that. So it's not the easiest environment to find hedges that work and that carry well, but it just felt like these options on the dollar were a potential option that could get you some protection against a bad risk off move, but not pay too much for it, basically, and have that protection for a good 6 months, right? If you're trying to buy 6-month protection in equities or bonds, it's going to cost you a hell of a lot more than it is in FX, right? But like I say, FX has now repriced a bit, so it's not such a screaming buy at these levels, which is why I've taken some profit. And then if it cheapens back up again, then maybe we'll see, maybe it starts to become something to add back to. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.